Hi guys, this is a very quick video on the trades I took today. I usually don't make these videos that often just because a lot of the trades are like the same and they're pretty boring. But the reason I want to make this video is because I want to show you that contract sizes matter, and it's also important to understand that you should always follow your strategy and stick to your strategy. And yeah, so today is June 4th, 2025, and we took three trades today, two winners, one loser, sorry. And so this trade, it has kind of different meaning from this trade. It was built off the um same like strategy, obviously, but the reason I exited here compared to here is slightly different. So market opened today at 9:30, obviously right here. And what happened was we saw a bit of a rise. We saw EMA was increasing. We could see the VWAP line. So if I zoom out, also this is the Nasdaq. This is not the S&P 500. This is the Nasdaq. So we could see that it's above the VWAP, signaling kind of a bullish market. And so we will, the stock market open. We kind of just passed the EMA, signaling a rise in the stock prices in the stock. And what I used is I used liquidity maps for this. I don't have any pictures for this one just because I have a lot of them opened for this and I'm going to show you. But basically, long story short is there was a liquidity map. It was in the range I wanted to be, so I bought in. Now, the reason I'm talking about this trade is not for the reason I got in, but it's for the reason I got out. And I think that's the most important for this trade. And so the reason I got out for this one is we were approaching 936, right? And I kind of wanted to hold it off. I wanted to send it up in the air. But the problem is that there was news coming out. So there was JOLTS news. So if we go on investing.com and we go right here, at 10 a.m. we had these news coming out. Now, the most important ones for this one is these two. And as you can see, the decline kind of played an effect right here. So the JOLTS news came out and we kind of went into this decrease. Now, yes, there is a big gap between here and here, but even though the news did not come out yet, there's forecasts. You could look at other JOLTS charts and you could kind of see where this is happening. Yes, it increased, but then it stayed very steady, dropped, stayed very steady, and then it slowly started to decline until it declined more. Now, the reason I bought out of this is because of the jolts, like I mentioned. And when we entered this position, we entered at two contracts of the Nasdaq, and we sold it right here and took profit. Now, this trade gave me, I think we made, $555 from this trade. I'm not going to calculate it, but it's around $555 from this trade. And so the reason I want to talk about the jolts is because this can give you very important information. So these two scores are the ones I'm going to emphasize a lot. These poor scores. Let me zoom in a little. So right here. So we have these two scores. And so the first one we're going to talk about is this one right here, the 49.9. So the ISM non-manufacturing PMI 49.9. As we can see, it is below 50, which is usually meaning a contraction in the US service sector. This is the first contraction reading since 2022, and it missed expectation of 52 and a prior 51.6. So these are the expectation, the prior, the now, and we missed it. And so this implication is basically saying there's a slowing demand, weaker business activity, and potential macro weaknesses, which is a reason that could have dropped the Nasdaq. I'm just going to call it the NQ. And so the other one right here we have, which was even more, is the ISM non-manufacturing new orders of 46.4. And so this is a sub-index within the PMI report. And so this a sharp drop from 52.3 forecasted to 46.4 is very alarming. And it shows a significant slowdown in incoming businesses for service-based companies. And so the implication in this is companies are seeing fewer new orders, which is a leading indicator of future slowdown. And so we could kind of see this, and which is why the stock price dropped. As we can see this little decline. Now, obviously, there's still other reasons for why that happened, but yeah. And so the reason it matters is because, so you can look at different sectors. In the equities market, the reaction is a risk-off bias, so it could sell off economic weaknesses. In the bond market, it might rally lower growth, lower yields. In the USD, may weaken it, lower growth, and then dovish Fed expectation. Commodities, demand-sensitive ones like oil could drop. Yeah, so basically in summary is these low ISM numbers signal contraction in the US service economy, which is a red flag for economic health. Traders may interpret this as a bearish for stocks and the dollar and bullish for bonds due to potential Fed easing expectation. And so if you were to long the NQ and this report came out weaker than expected, it could actually support a bullish reversal if the market shifts to a rate cut hopes, especially if yields drop. And so this is why we kind of sold off before the news came out, because, you know, as times come to the news, people are expecting other things to happen, or like even though the news didn't come out, you know, it could have caused some leaks or whatever. You know, it was better off to sell the position just before anything reversed, which is as it did. And so we're already talking about it, so I may as well explain what this is. So right here, very quickly, I'm going to talk about what everything means. I already talked about these three, but I do want to talk about this and this. So this is business activity. We had a value of 50 and a forecast of 53.7. The previous is neutral. And it's basically, the implication is it is dangerously close to contraction. Activity is slowing significantly down. And then for prices paid, which is right here, we have a value of 68.7, which was a forecast of 65.1 and the previous of also 65.1. And this is just saying hot inflation and then services inflation are rising again. So all these metrics and all these news coming out do affect the market. We have more Russian real wage and all this stuff. So yeah, that was that trade. The reason we left is because news was going to drop and, you know, I didn't want to risk anything. So that's what happened there. And so now we go here. So this was a winner. As of right now, we were up $555. You know, it was a good day. And so this is where it got scary. Not scary, but a little annoying. But then we recovered, obviously. So what happened here is, I have so many pictures. Sorry, I gotta find the picture. Oh no, 1 second. Okay, so if we look right here, right about here, when the price of the this is the SPX. So when the price was at 59.7.5. Also, the SPX and Nasdaq are very similar, so I was looking at the SPX. So as we can see here, is the price was just above my important liquidity markers. And so what happened is this drop kind of led to here. We also looked at this. Actually, 1 sec. Let me just quickly explain what these liquidity are. So the candlestick chart right here, it shows recent price action with candles representing short time intervals. So the price is hovering around 59.7.5 with a key level marked at HD 59.6.56. And so what that means is the likely stands for high gamma HD or high gravitation, so it depends on what you want to call it, is a level where option dealers or market makers may have leveraged hedging activity. And it's a level where price might gravitate toward due to open interest or gamma exposure. And so HP could mean high put volume, high probability zone, or a high volume nod on a volume profile. And this is a lower support liquidity zone. And so large volume bars are seen here, suggesting institutional interesting or resisting limit orders. And so the volume bars is the red and green bar, shows buy sell volume. And so there's a significant spike at HP 562.5 right here. It's suggesting a potential bounce zone or demand cluster. So these points I kind of see as bounce zones. So what happened here in this trade is we in the morning we went above it. And so no trades were made here. And then what happened was, as I'm going to show you in a bit, this point ended up dropping down to here. And so what I had is I was going to buy in here. If it drops a little, I'm going to sell and hopefully wait for it to go here or start a reversal. And I'm just going to spoil it right now. What happened was it dropped here. I bought. It dropped a lot, so I sold to save my position a little. The reversal started. I bought in and it went back up. If it dropped down all the way to this point, this would have been even more better, and there's a much higher chance of the bounce. And then the most beautiful out of the like beautiful point would have been this point right here, which the reversal would have been even bigger. Now, obviously, the best one would have been here because not only would the reversal be bigger, but there's a higher chance of it going up. But that did not happen. And so the way I use this is I use it as liquidity pools where price is likely to get magnetized or stalled. I use it as obviously support resistance zones, bounce zones. They're based on order book depth or volume clusters. And trade entries, exits. So reacting around these key levels when confirmed by price action or volume shift, which I just mentioned. Another thing I use is I use resilience charts. So this is this image. So these resilience charts. So what is a resilience indicator? Well, in this case, it usually refers to how well a market is holding up during selling pressures, how well a market is absorbing downward moves, how well it's rebounding after dips. And so this could be calculated from option flow, volume flow, liquidity absorption, and then market maker gamma positioning. So what we see right here is the top chart, which is the S&P 500, a resilience score of 28.1 compared to the Nasdaq's 45.9. And so this is a moderate resilience level, and it means the market is somewhat absorbing downside pressure, but not aggressively. The 15.8, the orange one, is likely a bearish pressure or kind of like a sell side resilience. And then the blue one is like a bullish pressure or a buy side resilience. And this gray point, this 0.0, is just may represent neutral delta, or total flow normalization. Same thing for the Nasdaq right here. And so the way I use this is high resilience score, so usually above 40, which we had in the Nasdaq. That's why we traded the Nasdaq. Is market absorbing dips. It favors long setups, especially on pullbacks. And then the S&P, which had a low resilience score, not that low. It's still above 20, which is good. But it still signals a weak buyers, easy to push down, and it favors short setups. And so what we did is we combined this, the VWAP, but you could also combine it with order book pressure, option gamma levels, liquidity zones, which I also did. And yeah, so EMA wasn't really played in this. It was more of liquidity zones and VWAP. And as you can see, we pulled back. And so the reason we bought in is because if we look at this, I have an image, I gotta find it right here. So this image right here, right about here when I bought in, we hit this point. And so what I saw is we put this point and we kind of wanted to see it reverse up this way. I don't think I could draw on this. Yeah, I definitely cannot draw on this. I probably can't. It's fine. So what happened is right about here, I wanted to buy in. We wanted to buy in. The problem is when we bought in right here, at this point, we were thinking of a reversal earlier. The problem was it didn't. It still went down. There could be other reasons for this. And so we bought in because the resilience score was much higher than the S&P. The NQ had significantly stronger buy-side resilience. There was a little sell pressure. The sell pressure of 15 was equal to the S&Ps, which combined with stronger buy-side suggested buyers were winning the battle. And so we bought in. This is where the problem came in. The problem was this happened. So what happened was it dipped down a lot more, and we lost a lot of money. Thank God that we were only selling one contract here, just because this is kind of a risky move. We're not at the lower liquidity zones, so we only bought one contract. If it was the other zones from earlier in the picture, the bottom points, then I would have bought like maybe 4 contracts and made a shit ton of money. But we didn't. So we only bought one contract. And so what happened is from here to here, This was 2 contracts, and we made $555. From here to here, it was 1 contract, and we lost $400. And so it was a little upsetting, but obviously I'm still gonna trust my strategy. And the price dropped from here to here. We sold out, and we kind of waited for the reversal to start. So I wanted to wait. Maybe it's gonna. Sorry, wrong picture. I could close this one actually. Maybe it's gonna start dropping down to the next liquidity zone, and if it did, then I would have bought it again and hoped for that reversal, which usually happens. But it didn't. What happened was it started the reversal, and I saw the reversal started. And I said, okay, we're gonna buy in. We're gonna try to get back to the point of here to this liquidity zone, in which it did, but we didn't sell there. So what happened was we bought in 1 contract again, and it flew off. In a matter of 4 minutes, it flew from here to here. From here to here, we made $555. From here to here, we lost, I think, 300, 400 something. By here, we were only up $75. And then the reversal started. We bought in again, and then it grew all the way up to here. We closed the position right here. At some point, we were up in the 1,000 profit. Unfortunately, I thought, maybe it's not going to end up hitting that liquidity zone. So it dropped down a little, and I sold. I took about, I think, $810. Yeah. Roughly around there. The profit's going to show up right here. I think it was $810 after my 75 from this loss. So $810, we sold out. I could have held it. Eventually, it ended up hitting that liquidity mark up here. But it's okay. So yeah, that's basically this. It was a lot of information, but basically what happened is this trade was taken. All these trades were taken due to liquidity zones. The reason this trade was closed was because of news that was coming out soon, and I didn't want any news information or forecasts that are like about to come out saying that it's going to ruin it and drop the stock and lose my profit. Right here, we entered a position that dropped below the liquidity zone, but it still ended up reversing up. So that's why we took the loss, but we bought back in and made money. And it is also important to understand contract sizes. Right here, we bought 2 contracts because yes, we were in the same liquidity zone, but it was an earlier time frame. It was more of a bullish market, as you can see. EMA. This is where we kind of had EMA play in with how many contracts we're buying. We were also above the VWAP. So we bought in the 2 contracts. That's why we took this quick profit. And then here we bought in 1 contract because we were hoping for the reversal, which did happen, but a little late. So that's why we took the loss. But then we recovered from the loss by making just under $1,000. And I could have held it and made even more money. But I'm not going to hold the stock for, first of all, I'm not going to hold it for an hour. Second of all, that is kind of stupid, to be honest. And, better take profits. At the end of the day, we made $885. I'm pretty sure that I already showed the profits. And yeah, I hope this kind of shows an idea of how I trade. I use liquidity zones and resilience, and I kind of work it around with VWAP and EMA to get some trading done. I don't make these videos that often. I only make videos that I think are important to show. I hope you guys watch this, enjoy this video, and I'll see you guys in the next one. Have a good one.